excited to share some updates with you. The traditional retirement model is broken, and there's a powerful reason why.
Visual. Cut to a graphic of a generic retirement timeline shattering, or crumbling. Most people believe if they work hard and stuff money into a 401k, they'll be safe. But rich people don't rely on these traditional systems. They understand that the math has changed. We are facing a systemic failure that is about to wipe out the wealth of the unprepared. But if you understand the mechanics, you don't have to be a victim of it. We are entering what economists are calling peak 65. In 2025 alone, a record 4.2 million Americans will turn 65. This is a retirement surge we have never seen before. Visual graph showing a steep vertical climb in retirement age population labeled the silver tsunami. The system wasn't built for this volume. It was built for a different era with different demographics and different math. Because of this, we are seeing the cracks form in real time. You've probably heard of the three-legged stool of retirement: Social Security, personal savings, and pensions. Well, pensions are gone. Social Security is on a countdown, and your personal savings are sitting in vehicles that are leaking value. Visual text on screen. 45% of older households lack basic income. The data shows that 45% of older adult households already lack enough income for basic needs. That isn't because they were lazy. It's because the rules of the game changed halfway through their lives. Today, we're going to look at the hidden mechanics behind this failure and what the wealthy do differently to protect themselves. Visual speaker walks slightly to the side. Graphics appear next to him showing a countdown clock. Let's start with the safety net.
Most people treat Social Security like a guaranteed bond.
But rich people know it's mathematically insolvent.
They know you cannot rely on a fund that is mathematically insolvent. Visual. Chart showing the Social Security Trust Fund depletion line intersecting with the year 2033. The latest projections are clear. The combined trust funds for Social Security are projected to be depleted by 2033. That is not 50 years away. That is right around the corner. When that happens, under current law, benefits would be automatically cut by about 23%. Imagine planning your life around a fixed income, and then overnight, nearly a quarter of it vanishes. Visual, animated graphic of a monthly check shrinking by 23%. This isn't political fear-mongering. It is simple arithmetic. The ratio of workers paying in to retirees taking out has collapsed, yet millions of people are banking on this money to cover their housing and food. Visual, split screen. Left side, average saver waiting for a check. Right side, wealthy mindset building assets. Poor people save money hoping the government keeps its promises. Rich people grow money so they don't need the government to exist. If your plan relies on full benefits starting in 2034, you are building your house on sand. The system is telling us loud and clear that it cannot support the weight of this new demographic reality. Now let's talk about where you've been told to put your own money. For decades, financial advisors have pushed the 60-40th portfolio, 60% stocks for growth, 40% bonds for safety, a visual pie chart of 60-40th split. The 40% bond slice turns red. The theory was that when stocks go down, bonds go up, protecting your money. That relationship has broken down. In recent years, we've seen stocks and bonds fall together. There was no safety. Visual text on screen. Morningstar, safe withdrawal rate, 3.7%. You might know the 4% rule, the idea that you can safely withdraw 4% of your portfolio every year without running out of money. That rule is dead. Morningstar recently lowered the estimated safe withdrawal rate to around 3.7%. Visual graphic showing a retiree wallet, 0.7%. You might know the 4% rule, the idea that you can safely withdraw 4% of your portfolio every year without running out of money. That rule is dead. Morningstar recently lowered the estimated safe withdrawal rate to around 3.7%. Visual graphic showing a retiree wallet. Money's flying out faster than it comes in. Why does this matter? Because if you have $1 million saved, which is more than most, 3.7% withdrawal gives you
Why does this matter? A 3.7% withdrawal from $1 million gives you just $37,000 a year. That's barely above the poverty line.
The 401k experiment is showing its flaws. It shifted all the risk from the employer to you. You take the market risk, take the longevity risk, and now you are taking the inflation risk. Rich people don't keep large amounts of money sitting still in these diversified traps. They know that diversification often just means you are losing money slowly in many different places at once. They focus on concentration and high-value assets that they control. Visual returns to the wide shot. The background lighting dims slightly to emphasize the serious nature of the next point. This brings us to the silent killer: inflation. Visual: an ice cube sitting on a table, slowly melting into a puddle. Text overlay: melting ice. Think of your cash like melting ice. You might see a number in your bank account, and it looks stable, but the purchasing power of that number is dripping away every single day. We've seen persistent inflation averaging about 3.3% recently. But the things you actually need, healthcare, housing, services, are rising much faster than that. Visual graph showing official inflation versus cost of living divergence, closing parenthesis. Banks pay you 1 to 3% interest on a good day. But real inflation quietly takes 4 to 6% every year. So even though your balance looks bigger, your money is actually losing value. If you are retired, this is catastrophic. A $5,000 annual shortfall, which is what the median retiree faces today, doesn't sound like much. But compounded over 10 years of melting ice, it forces you to sell assets just to buy groceries. This is the trap. You save, you scrimp, you put money in the safe bucket, and the currency itself is debased underneath you. Visual. Text on screen: 80% of older households are financially vulnerable. The data shows 80% of older households are financially vulnerable to shocks. A single medical event, a single market crash, or a few years of high inflation wipes them out. This is not a security system. It is a gamble. Asterisk, asterisk. Visual. The environment brightens. The speaker smiles confidently. The tone shifts to aspirational. Asterisk, asterisk. So what is the solution? Rich people understand this system. They don't play by these rules. Visual: B-roll of commercial real estate, successful small businesses, and stock charts moving upward. They don't focus on saving for a number, focus on investing for cash flow. Poor people save money, rich people grow money. Instead of a 60/40ths portfolio that hopes the market goes up, they buy assets that pay them while they sleep. They look for businesses, they look for real estate, they look for investments that adjust with inflation rather than getting crushed by it. It's visual text on screen: accumulation versus cash flow. The traditional model teaches you accumulation, build a pile of money, and hope it lasts. The wealthy model is cash flow. Build a stream of income that never runs dry. If you are over 45, you cannot afford to wait and see if Social Security gets fixed. You cannot afford to let your savings sit in melting ice. You need to shift your mindset from safety to growth. The retirement surge is here. The costs are rising. The system is straining. But this isn't a signal to panic. It is a signal to adapt. The tools to build real wealth are available to you.
Welcome to Wealth Vector Finance. Hit subscribe to join our community. Let's grow your wealth together.